What's going on, YouTube? Welcome to Credit Plug Vlog. So in today's video, I'm gonna lay out the blueprint. I'm gonna lay out the game plan on how you could get access to hundreds of thousands, if not millions of dollars in business financing. I'm talking about money that you could actually withdraw, cash money, business lines of credit, and then use those lines of credit to either acquire additional assets, so that could be other existing businesses, or something that's easier is buying non-owner occupied investment real estate or even commercial real estate. And I'm gonna show you the game plan. I'm gonna lay out the blueprint on how you can use this strategy to build continuous wealth. Now, there are some prerequisites with this particular strategy. Number one, you're going to need an actual business, right? A legitimate business that's transacting, that's bringing in some money. Now, it doesn't have to be a whole lot of money, but generating some type of activity. You're producing a product or service, and you are actually able to monetize the service or the products that you have. You have a customer base, just basic things that real businesses have, right? You have customers, you have transactions, you offer a product or service, all right? And so what you could basically do once you hit that 2-year mark, where you are 2 years minimum time in business and you have 2 years of business taxes filed. So most commercial banks, I'm talking about the big banks, mid-sized banks, credit unions, a lot of the business lines of credit unlock at that 2-year mark. Some instances it might be 1 year, some might be 3 years, but generally speaking, across the board, you're going to find that most commercial banks, business lines of credit, business loans, auto vehicle loans at commercial banks usually are going to unlock at the 2-year time in business. So once you have those 2 years of tax returns, you could essentially leverage that data point, leverage your tax returns and your personal credit in order to acquire hundreds of thousands of dollars in unsecured business lines of credit. And this is something that I've actually done. So I'm basically going to lay out the blueprint on how you can do this as well. Now, the prerequisite, again, a business, 2 years time in business, 2 years of business tax returns filed. And also, of course, you're going to want your personal taxes filed as well. And then once you're at that point, what you can do is open up multiple business checking accounts at different financial institutions. Now, the reason why you want to do that is because you want to build multiple banking relationships so that you can get access to the business lines of credit. Now, every institution is not going to be required that, you have an existing relationship, but I can tell you from experience, the more embedded you are with that financial institution, the higher the limit you're going to be able to get. And oftentimes banks will have their own internal bank score. So not only is it just based off of your personal credit score or your tax returns, but it's based off of the relationship that you have with them, what types of products you have with them, how long you've been a customer with them. For example, with Truist, they have relationship rewards. So because I've had an extensive relationship with them, I'm at the preferred tier. Now, that just goes to show the power of, business banking relationships, building that banking relationship, because, for example, I can get an interest rate reduction on certain loan products and certain limits, with certain loan products by being a preferred member, right? And so typically what you want to do is, you want to have a little bit of money. You don't have to have all of your eggs in one basket. I never keep all of my money in one financial institution, but you can, have your main operating account that, you're transacting from, and then maybe just open up, another checking account at another financial institution, multiple financial institutions. Let's say you do this with 5 institutions, just to keep it simple. So all of these institutions are going to offer business lines of credit where they'll give you an unsecured business line of credit as a percentage of your gross annual revenue. So for example, let's say, you make $120,000 per year. There are institutions that will give you 10% of your gross revenue in the form of a business line of credit. I know institutions that will give you 15%. For unsecured lines of credit, typically it'll be somewhere between 10 to 15%. I think Truist, for example, gives about 16.7% max, because again, their formula is a little bit different because they do 2 times your average monthly gross revenue. So it's a little bit higher than 15% or 10%. But pretty much, let's just assume you can get 10% at most banks. So if you're making $120,000 a year, you can then get 10% of that, right? So a $12,000 line of credit based off of that revenue. And like I said, some you can get more, but generally speaking, 10 to 15%. So let's say you have 5 institutions, right? So 12, 12, 12, 12, assuming each of them are 10%, some of them might be 15%. But if you have 5 institutions, you can get a $12,000 line of credit at each of them, just based off of course, your personal credit, but the main driver is going to be the gross annual revenue that's reported on your business tax returns. So just based off of that, you can go and get $60,000 from, let's say, 5 different institutions. And then the power of that is that each year when you file your taxes again, you can get reassessed for a higher amount. Now, what you can then do with that money, let's say with that unsecured line of credit, right? So with the unsecured line of credit, you could literally transfer that money to a checking account, to your business checking account, and you can pull the full amount. And that's going to be a little bit different than, let's say, business credit cards or charge cards, something like that. With business credit cards, let's say revolving business credit cards, if you want to pull cash off of it, you're typically going to pay, let's say, if you're doing a cash advance, which I would never recommend, you're going to be paying exorbitant rates. But generally speaking, a line of credit is going to have a lower APR than a credit card. So some of the lines of credit that I have, 8% annual APR, interest only, right? So you can make interest only payments. So you're not necessarily having to pay the principal. You're just going to be paying the interest on whatever amount that you draw down on. So at the end of the line of credit, because lines of credit usually have a certain term, like 12 months, 24 months, 36 months. I have a line of credit that's for 6 years. So it's a 72 months. So pretty much you could pay interest only for that full period. But at the end of, or, nearing the end of the line of credit term, you basically have to bring your balance back down to 0. So you pretty much, pay it down, get reassessed, and then you can start using it again and again. And so what you could typically do is, let's say you take those lines of credit, you pull the money off of them, and then you go acquire real estate, right? So you start buying, non-owner occupied real estate. And so you can rent that out and then use the rental income to pay down the line of credit, right? Now, the next step of this process is that you could leverage the property that you bought using the unsecured business lines of credit. You could take that property and go get a secured business line of credit. So this is not a HELOC necessarily, right? Because this is using a business asset as collateral for a business line of credit, a secured business line of credit. And usually banks will give you around, let's say, 70% loan to value. So you can then use that secured business line of credit and go buy another property, for example. Now, the unsecured line of credit and the secured line of credit work almost the same. The only difference is that with the secured business line of credit, you're just using the property, the paid off in full property that you use as collateral for the secured line of credit. And that's pretty much the difference. Now, one of the great things about the secured business line of credit is that because the limit of the line of secure business line of credit is tied to the value of the property that's used as collateral, the secure business line of credit can increase every year when you get reassessed, assuming that, the property goes up in value, which real estate usually does year over year. So let's say, you took that $60,000 and you bought a piece of property, you bought a rental property, and then the next year that property is worth $80,000. So instead of getting 70% loan to value on the business line of credit for $60,000, you're getting 70% LTV on $80,000, or, whatever the value of the property. I'm just using this, in this particular situation. So pretty much the secured business line of credit will grow as the value of the property increases. And technically there's no mortgage on the property. So a secured business line of credit using real estate as collateral is not the same as a HELOC, a home equity line of credit. So a home equity line of credit actually may report on your personal credit, whereas a secured business line of credit is not going to report on your personal credit. It may actually report on your business credit. So I know, for example, Truist, their secure business lines of credit report to Equifax Business and PayNet. So that's one of the ways that you can leverage initially your good personal credit in your business tax returns to get unsecured business lines of credit. Take those unsecured business lines of credit, purchase a non-owner occupied real estate investment, and then take that paid off property, that paid off real estate and property that you use the unsecured lines of credit to acquire. You can then take that property, rent it out, generate rental income, and use that rental income to pay back the unsecured line of credit, the unsecured business line of credit that you use to purchase the property. Every year, once that property increases in value, you can go back and get an increase to the secured business line of credit. And you can also get an increase to the unsecured business line of credit because you're going to have new tax returns that you can submit, and they'll assess you for a higher limit, assuming that, let's say, your gross revenue increased from the previous year, then you can get an increase to the unsecured business line of credit. So if they gave you 10% on $120,000. So let's say you increase your revenue from 120,000 to 240,000, then they'll give you an increase from 12,000 to 24,000, assuming a 10%. Now, again, some institutions might give you 15%. I know certain banks where they'll give you 15% of your gross revenue. So I'm just using that as an example. But pretty much you can get these increasing business lines of credit, unsecured business line of credit that's going to be tied to your gross annual revenue increases from year over year, and then also get an increase on the secured business line of credit that's going to increase year over year, assuming that the property that you purchase increases in value, which in real estate it usually does. So this is a way where you can initially leverage your good personal credit in 2 years of business tax returns to acquire unsecured business lines of credit, as well as secure business lines of credit, as well as non-owner occupied real estate investment property that's generating cash flow. Anyways, that's all I wanted to cover in today's video. Let me know your comments and questions down below. Till next time, take it easy, and we'll talk to you soon. Peace.